Hi everyone, welcome to today's video. So let me start today's video by telling you a very interesting 1 minute macroeconomics related story. So part 1 of the story is that going forward, China is going to dump a lot of steel in India. You might naturally ask me a question, why is that going to happen? Simply because of the viewpoint that there is excess production capacity in China as of now for production of steel, and their domestic demand of steel is not growing at a brisk pace. So naturally, India becomes one of the prominent steel dumping markets for them. You might say that, Akshat, you know what, that politicians are going to save us. They always save us. They are very noble people. The answer is, unfortunately, no. You can take a look at the recent budget announcement, and it was categorically stated that the anti-dumping duty for some of the Chinese steel has been done away with. And when it comes to big countries like US and China, India cannot flex a lot of its muscle. So this is the second key part. Now, third and the most interesting part is that politicians right now seem to have given up in terms of steel production industry in India. There was a recent announcement that was made that there is going to be a 15% export duty on steel from India. Now, as a result, what happened was that all the majority of the steel players in India, their stocks tanked quite considerably. And here's a very quick snippet for you. You can go through it. So the story for today that we are going to discuss is that, is it the right time to buy steel oriented stocks, or should you just do away with it? And what is it that I'm doing? I'm going to speak about two stocks that I'm actually selling. I will also explain you the rationale for it. When am I going to sell it? I will also tell you that. So let us first and foremost understand that how much steel stocks have fallen by and what is the reason for this prominent fall. So if you take a look at Nifty Metals, because Nifty Metals becomes a great proxy for us to understand how the entire steel industry is doing. So if you take a look at the last 2 months, you can categorically see that at the base, it touched roughly 28% discount. So Nifty Metals has fallen by 28% in the last 2 months itself. This is a major fall. Yes, there is a broad-based market correction that is happening, but with metal stocks, the correction has been almost 2x than that of Nifty. And this is a sign to worry. There are 3 specific short-term reasons as to why the steel stocks are tanking. So the first key reason is that the coal prices in India right now are very high, which leads to high cost of electricity, and steel makers require a lot of electricity. So therefore their profit margins will substantially go down. So therefore the steel stocks are falling. The second key reason is that the inflation pressure on other industries is going up. Because of supply chain disruption, because of the Russia-Ukraine war and bunch of other different macro factors, the inflation pressure on all the other major production-based industry is going up. Steel is a major raw material when it comes to any industry, be it housing, construction, heavy manufacturing, etc., etc. So what the government is trying to do is that they are trying to limit the prices of different input materials, especially steel. And as a result, they have increased the export duty of steel by 15%. So because of the combination of these 3 reasons, all the major steel stocks are getting corrected quite heavily. So to cut the long story short, in order to save other industries, steel industry has to suffer, and that is the viewpoint that our government has unfortunately taken. Take a look at this particular chart. You will be surprised to know that steel manufacturers were actually doing fairly well. They were actually making profits. Many of them have brought down their borrowings. Many of them were being very effective in terms of expanding their operating profit margin. Many of them were exporting to high value countries and were preserving their profit margins, and rather expanding their profit margins. But unfortunately, due to this 15% export duty, it's almost impossible for these steel manufacturers in India to be competitive at a world scale and start supplying that steel outside India. So what is going to happen in India? So it is fairly simple that the local supply is going to increase not only from Indian steel manufacturers, but also from the steel that is getting into India from outside. And as a result, the overall prices are going to come down for steel. And steel manufacturers again go back to that same old situation where they are literally selling a commodity product and they are not making any major profit margins. So now you might have a counter question that, okay, other industries also need support. They need to keep their prices down. They have also suffered a lot. So why is it that you are favoring steel industry so much? The reason is fairly simple, that you're not letting the free markets work. And to what extent can you intervene in every single industry? Because the long-term message that this gives out to a bunch of other players from outside India is that, you know what, Indian government is very middlesome. So they might think twice before making these large cap investments, especially on these capital intensive industries like steel. If you think about this entire situation rationally, 2 things will stand out, and these 2 things should worry you. First and foremost, the industry was in an upswing. For example, take a look at this chart. It categorically points to the fact that India's demand for steel was going up when the world's demand was coming down. So which is a great sign if Indian steel manufacturers would have had a choice that, you know what, I'm producing 100 tons of steel. I get an option to give it to Indian consumers vis-a-vis consumers outside India, wherever I'm making profit. So I would have benefited from this industry upswing. The second key point and the more worrisome point is that for the last 1.5-2 years, steel manufacturers or many of the steel manufacturers in India were making very good inroads and profits. So let me take you to the example of Tata Steel and show you something very interesting there. So first and foremost, take a look at this balance sheet, and what you would notice is the amount of borrowing. So it was going up until 2019. In fact 2020, and since 2021 they have been trying to bring their borrowings down because steel is a very infrastructure heavy industry. It requires a lot of capital influx and a bunch of other capital moves. So for such an industry, it becomes very important for these large players to be cognizant of how they are spending their capital and not do too much work in terms of their debt. So all the major steel producers in India were at least trying to bring down their debt. They were trying to run their operations profitably, and whatever money they were making, they were trying to pay off the borrowings and reduce their borrowings. That could have created such a positive impact on the entire steel sector. But unfortunately, now going forward, due to this increase in 15% taxes, it looks very unlikely that these steel producers will keep their profitability intact. So you might say that, okay, in the short term, the situation for steel producers does not look very positive, but what about long term? Does the industry still have very strong growth prospects? So let us take a very quick look at that. So here is an excellent chart that comes from IBEF. It talks about that the demand for steel in India is going to go up. Agree, that's a very good sign. There is increasing investment. Okay, now after this move, I don't know if this situation is going to stay intact. Policy support, again, this is highly debatable. Competitive advantage, if we say, again, it is getting crushed. Even if you study the steel sector after this recent move, the situation is actually very troublesome. Given the fact that capital everywhere is drying up across all industries, a lot of countries are making dramatic moves across their different industries, and this can create a very negative long-term impact. But let us not discount this so soon. Let us look at the cyclicity of steel, because if the world demand of steel goes up quite considerably going forward, then even the steel produced in India will still find profitable customers outside India. So if you take a long-term view on Nifty metals, what you will find is that metals or commodities will have a fairly long cycle. For example, here you can see that from 2018 onwards, all up till the point of 2020, for approximately 2.5 years, the steel sector was going down. Previously, there was a 2-year cycle when steel was going up. Now, after 2020, the steel had been going up and now it has started to come down. So one could argue that commodities / metals / steel is very cyclical in nature. So whenever there is a rebound in the entire industry, these stocks or steel stocks will again bounce back quite aggressively. And I do not discount that fact, but predicting this market cycle is really complex job. Even producers and consumers of steel that are investing billions and billions of dollars, even they are not able to run this analysis properly. Now, on top of this cyclicity point, there is another good positive factor at play, and take a look at this particular graphic. What you would notice is that India is focusing a lot from a policy point of view in terms of running the PLI scheme, and steel forms a part of it. Approximately 6,500 crore rupee has been dedicated to steel industry. And one could argue that again, steel industry or steel stocks will benefit as this policy comes into effect. So these are all positive points, but before you jump into buying these stocks at a dip, please understand the risk part of the equation as well. So let me take you through a few key points here. So first and foremost, take a look at this particular chart, and this is a very worrying chart. It shows the production capacity of different countries and how they have been increasing their production capacity over the last 3 years. What you will notice is that the production capacity of China is almost 10 times that of India. Yes, we could argue that, as a country, India is at number 2 because second is the European Union, which is not a country per se. So yes, it looks great that, that we are the second largest steel producers of the world, but the difference between first and second is huge here. Now, the second key thing that you will notice from this particular chart is that China has been increasing its production capacity while the world is bringing that production capacity down. So what does this tell you about Chinese intention? It's very evident that if this excess steel does not get consumed within China, what are they going to do with it? They are going to dump it on someone. So then comes the natural question, where are they going to dump all this excess steel? The answer, unfortunately, like India, plus there are other countries, but India becomes a major prominent market. I will also explain it to you why. But let us first study the viewpoint of Ravi Uppal, who is the MD and CEO of Jindal Steel. So he says that as the supply of steel is much more than its economic demand, the Chinese have started to dump steel in overseas market. The major export market apart from India are all these different countries. So the point is that due to excess production capacity of steel and the lack of growth in terms of domestic consumption of steel, China has to dump it on a country like India. Now, some of you might ask me that, Akshat, okay, why is it that the Chinese demand of steel will go down going forward in the future? So here are a very quick snippet, and then I will break this argument apart for you. So you can clearly see that China's steel consumption will peak at 900 million tons before falling to 700 million tons by 2035. This is as per CISA report. A natural question comes, why will this phenomena play out? So you would need to understand where steel gets consumed. And there are three major sectors at play. One is housing or construction. Approximately, it is estimated that 15% of world steel gets consumed in Chinese housing market itself. So which is like crazy number. The second key industry where steel gets consumed is heavy industry. And China is moving away from heavy industry to slightly high-end industries. So their demand in industry segment is going to come down. Third and final sector is the auto sector. A lot of manufacturing of cars has moved out of China due to competitive advantages in terms of labor and bunch of other different factors. So again, the speed of growth of demand compared to the production speed of steel in China, those two are diverging. Can I show you some data around it? So an easiest data or proxy point could be the urbanization. So let us quickly compare the urbanization study of China between 1980 to 2021 to that in India. So you can clearly see that urbanization in China used to be roughly 20% 40 years back. Now it is at approximately 64%. There is hardly anything left to be urbanized, so to say. Now, why am I picking urbanization? Because urbanization simply says how people are moving from rural to urban, which will lead to more buying of car, more creation of houses, more creation of heavy industries, whatnot. So to cut the long story short, China is already peaking when it comes to urbanization. So therefore, the rate at which the steel is going to get consumed in China is going to go down. So what about India? You can clearly see that our rate of urbanization is still at approximately 35%. Still a huge way to go. And therefore, government should be supporting steel producers, bringing in more money for steel manufacturers in India, trying to make it more efficient rather than putting like more and more export duties. This is a very short-sighted policy move, which will have a lot of negative repercussions. So the word of the day today is repercussions. Let me know what does that mean. So this will have a lot of negative repercussions on a series of industries which are trying to find their foot in India. Now comes the final chart that I would want to show you, because a natural question here would be that can't India fight this anti-dumping war? The short answer seems like a no, and this chart will prove that theory, because here you can see that our dependence on Chinese import has been growing over the years. So take a look at probably 2017, 2018, 2019 and 2020 data. You will see that this difference between blue and red chart has been growing over time. Now, when anti-dumping wars are fought between two nations, be it India, China, India, US, China, US, it all comes down to how much you are importing from that country vis-a-vis exporting. If India can figure out other ways of importing the material it is importing from China through other countries, then yes, India can definitely prepare better and fight that anti-dumping war. But at least as of now, that doesn't look to be the case. So with that viewpoint in mind, there are two stocks that I will be selling. I internally do not see any issues with these companies. Therefore, I had purchased it in the first go. But looking at the policy level changes, I am not bullish about these two companies anymore. These are good businesses. Let me first and foremost tell you, it is just that the policy situation in India doesn't seem to be favoring these two companies. So therefore, I'll be selling them. Will I be selling them right away? The answer is no. I'll be selling them at an appropriate time, and I will let you know also. But for the time being, I've made up my mind that I'll be selling these two stocks. So the first stock is NMDC. I have been fairly bullish about this company, and I'm sitting on a profit on NMDC stocks, by the way. If you do a very quick fundamental analysis, you will see that the performance of the company has been going up. Their profit margins have been improving, that the total sales of the company has been going up, their net profits have also been increasing. But due to this sudden change in the policy environment, I don't see that this company is going to compete in the next 5 years or so. So therefore, I don't see any point in terms of holding this company as of now. Is it a good company? Yes, it's a monopoly oriented company. It's a very good company. I had done an analysis of this company earlier. Internally, there seems to be no issues in terms of steel manufacturers, but due to policy change, these companies are going to suffer more. Then the second stock that I'm going to sell, these were the two steel-oriented stocks that I had in my portfolio. I'll be selling off SAIL, or Steel Authority of India Limited, as well. Again, the same story there. Sales have been growing, profits have been growing. No internal issue seems to be there with the company. But policy moves have literally rendered these businesses incompetent, and I don't see any reason why these companies are going to do well compared to their global peers. I'll be selling sale on a loss, by the way. So what is the key lesson that I have learned in this? So my learning is fairly simple, that hey, do not invest in businesses which look really good, but they are heavily supported by the government. If the government intervention is really, really high, tide can turn anytime on any good company also. So from now on, I'll be very, very mindful in terms of investing in companies where the government intervention is higher than usual. And unfortunately, steel or any other commodity becomes one such business. Thank you so much for watching this video, and I will see you tomorrow.